teach you. Support is a floor where price stops falling. Resistance is a ceiling where price stops rising. Draw horizontal lines where price bounced before. Done. But here's the problem. This approach treats support and resistance like physical barriers. They're not. They're zones of supply and demand. They're psychological battlegrounds where buyers and sellers fight for control. Think about it this way. When price approaches 1.2000 on Euro-USD, millions of traders around the world are watching. Some have pending orders. Some have stop losses. Some are waiting to enter. Some are ready to take profit. It's not a line. It's a zone of accumulated orders. This is why price doesn't bounce exactly at your line. It overshoots, it undershoots, it creates wicks because it's interacting with thousands of orders, not a single barrier. The first principle, support and resistance are zones, not lines. Always mark them as zones with a range, not a single price point. There are actually 3 distinct types of support and resistance, and each behaves differently. Type 1. Historical support and resistance. These are your basic swing highs and lows. Price touched here before and reacted. The more times price touches a level without breaking it, the stronger it becomes. But here's what they don't tell you. Old resistance becomes new support, and vice versa. This is called a polarity flip or role reversal. Why does this happen? Because traders who missed the breakout are waiting for price to come back so they can enter. This creates buying pressure at the old resistance level, turning it into support. Type 2. Psychological levels. Round numbers. Every trader watches them. 1.3000, 100.00, 2000. These are self-fulfilling prophecies. Institutions place orders here. Retail traders place orders here. News headlines reference these levels. The market respects them because everyone is watching them. But here's the pro tip. The real action often happens 5 to 10 pips before the round number. Why? Because smart money knows everyone is watching the round number, so they front-run it. Type 3. Dynamic support and resistance. These move with price. The 50-day moving average, the 200-day moving average, ascending or descending trend lines. These are powerful because they adapt to the market's current momentum. Professional traders use the 200-day moving average as a major support or resistance level. When price is above it, the bias is bullish. Below it, bearish. It's that simple. Each type of support and resistance has its place. The key is knowing which one matters most in your current market condition. Not all support and resistance levels are created equal. Here's the hierarchy of strength, from weakest to strongest. Level 5, weakest, single touch. Price hit this level once. It might matter, it might not. Don't bet your account on it. Level 4, double touch. Price touched twice and bounced. Now it's worth watching. The level is being validated. Level 3, multiple touches. 3 or more touches. Now we're talking. This level has proven itself. Traders are watching it. Orders are stacking up here. Level 2, confluence zones. This is where multiple factors align. A historical support level that also lines up with a psychological round number and sits on the 200-day moving average. That's a fortress. Smart traders look for confluence. When 3 different types of support or resistance align, the probability of a reaction skyrockets. Level 1, strongest, HTF support resistance. The higher the time frame, the more powerful the level. A support level on the weekly chart carries far more weight than one on the 15-minute chart. Why? Because it represents more accumulated orders, more traders watching, and more capital at stake. Here's your action step. Always check higher time frames before taking a trade. If you're shorting into daily support, you're fighting a losing battle.
Now let's talk about what really frustrates traders: false breakouts and stop hunts. You see resistance at 1.2500. Price breaks through, you enter long, excited about the breakout. Then, price immediately reverses and stops you out. Sound familiar? This isn't bad luck. This is designed to happen. Why false breaks occur? Large institutions can see where retail stop losses cluster. Below support levels, there are thousands of stop-loss orders. Above resistance levels, thousands more. Before making a real move, smart money often triggers these stops to grab liquidity. They push price just far enough to trigger the stops, collect the orders, then reverse in their intended direction. This is called a stop hunt or liquidity grab. How to identify a false break? Number 1. Look at the candle that breaks the level. If it's a long wick with a small body that closes back inside the range, that's a classic false break candle. Number 2. Volume. A genuine breakout has increasing volume. A false break often has normal or declining volume. Number 3. Context. Is this breakout happening in a major news event? End of trading session? These are prime times for fake moves. How to trade it? Option 1, wait for a retest. Don't trade the initial break. Wait for price to break, pull back to test the broken level, then continue. This filters out most false breaks. Option 2, trade the reversal. If you spot a false break in real time, trade back into the range. Your stop loss is beyond the wick, and your profit target is the opposite side of the range. This is an advanced move, but it's incredibly profitable because you're trading against trapped traders who entered the false break.
Let me show you how professional traders actually use support and resistance. Step 1. Mark your zones on higher time frames. Start on the daily or weekly chart. Identify the major swing highs and lows from the past 3 to 6 months. Mark these as zones, not lines. Use rectangles to show the area where price reacted multiple times. Step 2. Identify confluence. Where do your zones line up with round numbers? Where do they meet major moving averages? Where do Fibonacci retracement levels align with historical support? These confluent zones are your high probability areas. Step 3. Wait for price action confirmation. This is crucial. Don't just trade because price touched your zone. Wait for confirmation, a strong rejection candle, an engulfing pattern, a pin bar. These signals tell you that buyers or sellers are actually defending the level. Step 4. Plan your trade. Your entry is on the confirmation candle. Your stop loss goes just beyond the zone. Not tight, but reasonable. Your take profit? The next major zone in the opposite direction. Risk to reward matters. If you're not getting at least 1 to 2, don't take the trade. Step 5. Manage the trade. Once price moves in your favor, trail your stop to break even. Take partial profits at obvious resistance levels. Don't be greedy.
Let's quickly cover the 5 biggest mistakes traders make with support and resistance. Mistake 1. Drawing too many levels. Your chart shouldn't look like a prison cell. More lines don't mean better analysis. Focus on the obvious swing highs and lows that everyone can see. Mistake 2. Ignoring the higher time frame. Your 5-minute support level means nothing if it's crashing into daily resistance. Always check higher time frames. Mistake 3. Treating levels as exact prices. Zones, not lines. If you're waiting for price to hit 1.2500 exactly, you'll miss trades that reverse at 1.2503. Mistake 4. Trading every touch. Not every support or resistance level will hold. Context matters. Market momentum matters. Don't blindly trade every level. Mistake 5. Forgetting about fundamentals. Technical analysis is powerful, but if the Federal Reserve just raised rates, your support level might not matter. Stay aware of major economic events. Support and resistance. Simple concept, but infinite depth. Remember the key principles. Zones, not lines. Higher time frames carry more weight. Confluence increases probability. Wait for confirmation. Be aware of false breaks. The traders who master this concept don't just draw better lines, they understand the psychology behind every level. They see the battle between buyers and sellers. They recognize when institutions are hunting stops versus making genuine moves. This knowledge alone won't make you profitable. You need proper risk management, emotional control, and experience. But understanding support and resistance at this level, it's the foundation everything else is built on. Your homework. Open your charts right now. Mark your major support and resistance zones on the daily time frame. Watch how price reacts this week. Document what you see. That's how you truly learn. If this video changed how you think about support and resistance, leave a comment below telling me which section was most valuable to you. And if you want more content that goes beyond the basics, subscribe and turn on notifications. Trade smart, trade safe. I'll see you in the next video.